Okay, this chapter in business finance deals with estimating cash flows and calculating those into a capital budgeting decision and also analyzing risk. So we have a capital budgeted decision that is going to cost us $140,000 with $30,000 necessary to deliver and install it. It's going to be depreciated under the maker's 3-year class, and it gives us the depreciation rates for those. So, and again, there would be a table in the back of the book, but it gives them to you. It's 33%, 45%, 15%, and 7%. And then it tells us that after 3 years, it could be sold for $60,000. Okay, then it also tells us that there's going to be an $8,000 increase in the net operating working capital. And what we have to remember with that is that's going to be added to our initial investment. It's money that the company has to have initially in order to get this project up and running. So we not only have to buy the new machine, pay to install it, we now have to have spare parts inventory necessary to run it. So that again is going to cost us a little more money. But then we don't depreciate the working capital. We're only going to depreciate the cost and the installation. Okay, then it tells us that it should save the firm $50,000 per year in costs. So the first thing that we're going to have to calculate is what is that initial investment. So basically what I have mapped out right here, the cost, the installation, and the working capital, this is our initial investment. And then if you're thinking in terms of putting that into the cash flow function of your calculator, this is going to be your cash flow for year 0. Okay, then we have to do our incremental cash flows for the future years. So we would have year 1, where we're going to have $50,000 of savings, but then we're going to depreciate the $170,000 times 33%. So $170,000 times 33% gives us $56,100. Again, and that's depreciation. $170,000 times 33%. So then I subtract that out, and then I have a loss of $6,100. And then that loss I get to take on my taxes. So it's going to help me save. It'll offset taxable income, so there will be a tax benefit to that. So then if I want to take the net of tax, I multiply that by 60%. So again, 100% minus our tax rate. And then that gives me $3,660. Again, still a loss from an income standpoint. And then what we're focused on here is cash flow. So if I'm focused on cash flow, I don't care about depreciation. So I'm going to add that back because depreciation is just a journal entry and it doesn't involve any cash. So then that gives me $52,440 as my cash flow for year 1. Okay, then I do the same thing for year 2. Now the only thing that's going to change is because I'm using that maker's accelerated depreciation, I got to go up to 45% here. So the $170,000 times 45% is going to increase that depreciation amount, and that takes it up to $76,500. And again, I'm subtracting that. So then that's going to leave me a loss of $26,500. And again, though, I still will have a tax benefit to that because it's going to offset future taxable, or this year's taxable income. So then now if I multiply that by 100% minus my tax rate, or 60%, that calculates it net of tax. So that's $15,900, again, still negative. But that's income, and what we're really focused on, again, is cash flow. So now we're going to add back our depreciation expense. So then that takes us up, whoops, I did that wrong. So that takes us up to $60,600, and that's my cash flow for year 2. Okay, and I'm going to jot these numbers over to the side. Because then year 3, I'm going to have a similar scenario in that I still have one more year of operations, but now I have to factor in that I can sell this piece of equipment for $60,000. So I have one more computation to make. So I still have my $50,000, and then I still am going to calculate my depreciation according to my schedule. So now I'm at 15%. So 170,000 times 15% gives us depreciation of $25,500. I subtract that. So now I have income, $24,500. And then again, though, that's going to be subject to tax. So then to calculate it net of tax and just save us a mathematical step, I can multiply it by 60%. So that's $14,700, and that would be my income for that year. But then I want it as a cash flow, so I add back my depreciation. And that gives us $40,200. And that's going to be part of year 3's cash flow. But then now it says at the end of year 3 I can sell the equipment. So then at the end of year 3, we started with $170,000, and we depreciated 33% in year 1, 45% in year 2, and then 15% in year 3. So all that's left is that. So then if I take that $170,000 and I multiply it by 7%, I have an $11,900 net book value. If I compare that to what I can sell it for, I have $60,000 of proceeds minus my $11,900 net book value. That gives me a $48,100 gain. And then the only reason we care about the gain, because sometimes this messes students up, the only reason we care about the gain is because they're going to have to report that on their tax return, and they're going to owe taxes on that money. So now we multiply that by our tax rate. Again, we're not taking it net of tax like we did here. Net of tax just meant we calculated the 40% and we subtracted it. In this case, we just want to know what do they owe. So we're going to just multiply it by the 40%. That gives us a $19,240 tax liability. So then now we look at our whole salvage value to say, okay, we're going to get $60,000 in. We're going to owe $19,240 in taxes. Because again, we're focused on cash flow. And then we're going to get a return of our net working capital. So our net working capital, if we sell this piece of equipment, we no longer need that spare parts inventory. So then now we can add all of those up. So we'll get $60,000 in when we sell it. We'll owe the IRS $19,240, and then we will no longer have to have $8,000 tied up in spare parts inventory. So then that is our salvage value. So then now these two added together equal our cash flow for year 3. So that is $88,960. Okay, so then now we've kind of mapped it out. We know what our initial cash flow is. We have mapped out the incremental cash flows for the 3 years till we get to the end of the project. Then it tells us if our weighted average cost of capital is 12%, should we purchase this piece of equipment? So again, to save my board space, I'll erase this. So then now we go to our cash flow function. Our cash flow for year 0 is this initial investment, $178,000. Make it negative though by pushing the plus or minus button because it's money I'm giving up today. Then look back at the computations, but our cash flow for year 1 was $52,440. Our cash flow, and that's just a frequency of 1. Then our cash flow for year 2 was $60,600, and that is also just a frequency of 1. And then our cash flow for year 3 is going to be the bigger number, the $88,960, because we not only have year 3's operations, but then we have that terminal cash flow. And that's a frequency of 1. Then if we come over and we push our net present value button, we make our I equal to that weighted average cost of capital, which it tells us is 12%, and then we compute. All right, so I'll go to my cash flow function and put these in. So $178,000, again, make it negative by pushing the plus or minus button, push enter, arrow down, $52,440, push enter, arrow down. Make sure your frequency is a 1. If it's not, make it a 1, and push enter. Cash flow for year 2 is $60,600, push enter, arrow down, frequency of 1, arrow down. $88,960, push enter, arrow down, and it's a frequency of 1. Then if we come over to the net present value, we make our I equal to 12, and then push enter, arrow down, and then push compute, and we get a negative $19,548.65. So we go back to our rules. If it's a negative net present value, we would reject. If it were positive, then we'd accept. So now this chapter, we get into all of the details of those cash flows. If you had had a straight line depreciation, it would make it a little bit easier. All your incremental cash flows until you got to the terminal salvage value would be the same. You would take that, if it were a straight line, you would take this $170,000 and divide it by 3, or if that was a 3-year project. So just keep that in mind because you can have some that are straight line. Okay, and that is it for this chapter.